chasing the easy life. We're chasing the easy life. We're chasing the easy life. We're chasing the sun tonight. We're chasing the easy life. Easy life.
What's up, guys? So today I want to talk about something pertinent more to individuals, and especially younger people who are just starting to work and starting to make money, kind of like how I was. I guess still am, but more so when I was in my early 20s after I graduated from medical school and whatnot. And I'll talk about some of the strategies I used that worked well for me. So again, you should always think about stuff and talk to your financial advisor. This is not financial advice or whatnot. It's just my personal opinion of what I did, what worked well for me. So take it for what it's worth. So one of the most common, misconception misconception and advice that just people just use it like everywhere is diversification, right? So I'll tell you how I interpret it, how I use it, and how I don't use it. So diversification is obviously a good risk mitigation strategy. I personally diversify my asset classes. So what that means is I obviously, number one is diversification. That concept is similar to having multiple revenue streams, right? So it's the same thing. You're mitigating risk by having different paths to a particular goal, so that if any one path faces an obstacle or a slowdown, you're still okay, right? So that's one of the ideas and common traits that most people who are financially free or well off have, is a diversified portfolio or revenue stream. But let's go back to the portfolio aspect first. So for me, I have real estate investments. I have long-term investing account. I have a swing trade account. I have a day trade account, and I also have a few different retirement accounts as well. And the reason for this is, and I'll go into each, starting with investing, is they have different strategies and different outcomes. So it's similar to the concept, if you're familiar with, like, you do not want to finance long-term debt with short-term debt and vice versa and stuff like that, is you don't want to commingle your objectives and your strategies because they're very different. So for me, long-term investing, I look at sector in particular, what sector may be hot, what sector is not, and companies in that sector that may have traditionally be undervalued, right? So for me, I take a very broad and long horizon on this. So when I first started working, I actually started investing way back in medical school, way back in I think 2006-ish, 2007-ish. And then I started investing much more heavily long-term wise in 2008 as the market was going down. And I looked at sectors that were undervalued. For example, financial sector, there were a couple of stocks back then. Obviously, some went bankrupt, obviously, but the ones that did not actually did very well for me. So I diversified across that sector. I bought a lot of stuff that, and obviously there's a lot of research involved when you do this. You have to look into the stocks, look at, well, what I personally like to look at is the leadership team and also the rationale for why a stock dropped, right? Sometimes it could be the sector brought it down, but actually it's doing well. I looked at the balance sheet, you know, all the fundamental stuff. But one of the key things is executive teams. If you have an executive team that is, you know, the executives themselves somehow got to become a CEO, COO, CFO, whatever, through connections, which happens a lot, or for political reasons why they were put in place, it's probably not a good company to invest in. Not sector, company, not a good company to invest in. You have to really believe in the team. Look at their CV, their resume, look them up. That's what I do, and I don't really track the long-term investment as much, because what I do is I just put money in there and just follow the news and all that, just to ensure that it's not going to go belly up on you. But otherwise, I would say it's fairly passive in a relative sense, relative to the other two types of investment. So for swing, is a lot of times, for me personally, I like to look at I like to swing two types of two groups of stocks. One are ones that I'm familiar with. I'm okay with being in it long term, so I'm very familiar with those stocks. And oftentimes they enter a channel. So it's a technical term here. So and as you can see, as I move from a long-term investing horizon to a shorter one, I shift more from the fundamentals to the technicals. So some stocks, they enter some sort of channel and then they sort of fluctuate around there. Let's say between $10 and $20. So some days it's around $9.50. Other days it's $13, and then it may pop to a high of 21, and then it'll go back down to 15, and then 11, and then back up to 18, and then down to 13. Stuff like that. So when that happens, I like to take a position in those stocks, define a stop loss that's slightly below the channels, and basically exit as it moves up the channel. So that's what I do for some of them. Other strategies that I use are for hot sectors or whatnot. There's a investing group that I am a member of, Bear Bulls Trader. Brian Paz actually has a book on how to swing trade. Literally, that is the title. You should find it on Amazon. I may have the link below, but you should buy it. They're very good guys. And then Andrew Aziz talks about day trading, which we'll go on to next. But yeah, I do swing trading. There's a lot of technicals that are involved. I don't want to get into it because I'm not an expert. Brian and Andrew and those guys are. So you should probably watch their videos, their channels, and buy their books. So, and then day trading, I try to day trade, consistently every day. It doesn't happen because I also work, and that makes it complicated. But usually, you can be done in like an hour and a half, especially when you live on the West Coast like myself. And this is heavily technical analysis. You don't really care if the stock is like bellying up or whatnot, whether the market's doing well or not. You just play the trends, whether it's up or down. Doesn't matter to you. You just want to make sure that you exit all your positions, define your stop loss and whatnot. And that's another way for me to make money on, outside of, my work. And obviously the horizon there is very different, right? Long term, you kind of treat it like a piggy bank. When it dips, you buy. You don't really follow the stock, second by second, what you do in day trade, or day by day, or week by week as you do a swing trade. I keep tabs on it, but I don't monitor its price action, its movements, all that. It just drive you crazy. You just need to know that the fundamentals are sound, market may undervalue it, and you just buy into it. And then of course, real estate has a lot of more complex field. And I looked at different regions. I look at what I can do with it, its potential for rent positive cash flow when I invest, and also how desirable the area is, the general market. Like right now, I'm not buying anything. I actually sold a lot of my rental properties, so I'm just holding cash right now until the market readjusts, and then I'll go back in. But things like that for real estate. Obviously, it's much longer term. I may want to look into shorter term types of real estate investment, but that is something that I'm still researching before doing anything about. So that being said, the different diversification at a very high strategic level makes a lot of sense for me, right? Because, long-term investing in a market that's going to be kind of down, like what I anticipate the market to be, you can't really focus on that to be your moneymaker. It's not going to happen, right? But in the long term, you're picking up a lot of value assets on the cheap. So, but you can't really rely on that as income. And that's the big difference, right? Is long-term investing is wealth building activities. It makes you wealthy. Real estate makes you wealthy. Long-term investing in stocks, holding big positions in fundamentally sound stocks, that makes you wealthy. Day-to-day wise, some days are up, some days are down. It's not gonna, you can't pay your bills with it. But for swing trades and day trade, that's what you pay your bills with, right? You can make money, but you're always capped. Even if you're really, really good, there's only so much you can do with the amount of money that you have, the time, and the positions that you can take without being at risk. And what I mean by that is, if you ever day trade or whatnot, you understand is sometimes you take a position, especially with some low float stocks. That's why I don't like trading low float stocks, is because it's hard to get out of a position that you're in. Those are some challenges with regards to day trading, and it's more or less an activity where you use the money that you get to pay for your bills. That's it. So diversification works in that manner, and as you can tell already, the strategies are different. But what I don't do, and I don't diversify, are my portfolio, within my portfolio holdings. So that has to do more with the long-term investment. And the reason for this is, if you think a certain sector is good, why are you going to diversify across the sector? Why are you picking things that are, counter to one another at the same time? That doesn't make sense. You should anticipate what goes on, start taking a small position and then enlarging that position as you find out that you're, as uncertainty raises, right? The reason why rich people diversify is because they have money and they take a defensive position. For someone like myself, I grew up poor. I needed to build wealth fast. So when I had money and when I started working, I didn't diversify. I picked something that I was fairly confident in, and I went all in, more or less. And the reason for that is because you're in an aggressive growth strategy. So you should not take positions in sectors or companies until you're comfortable, you're well researched, and at the same time, you don't go all in at the same time, like right at once. You start to slowly increase the size of your positions once you have confirmation that it is correct. And you should always, that's why you keep tabs on your investment to make sure that, hey, if you're wrong, you're okay with exiting. Because no matter what, when you put money into something, there are chances that you will lose all of your money. So you have to be comfortable with that. I am, because what's an extra 10,000, 100,000, going to do for my happiness? It doesn't. It's not a life-changing amount for me. But if it's $1 million, $2 million, it is. So from that perspective, I'm comfortable with making the investments that I do. Of course, I also have a rainy day fund where I can still pay for my existing bills. So, it's stuff that you have to work out for yourself and with your investment advisors and so forth. So that being said, that's my take on diversification and why I don't diversify within various asset classes. But again, it's really, all of this is really up to the individual's level of comfort when it comes to your investment. But that's my take on investment. Advice that people generally give is diversification and whatnot. Diversification is good. I hold money in cash. I hold money in various types of cash, like besides stock, the stuff that I mentioned, like I invest in like gold and silver and stuff like that too. But the amount that I hold is very different. But you always want to make sure that no matter what happens, you still have very liquid capital to use. But within classes, like I said, I don't generally diversify. I pick what I think will be the best, a few. I shouldn't say pick one, but I pick a few that I think are generally going to do very well for me, and I invest heavily in it. But I make sure that if I'm wrong, I don't end up being too emotional about it and not exiting when I should. I constantly make that mistake. I think everyone does. Very few people don't. But if you catch yourself and you continue to practice what you preach, you know, and keep telling yourself that, one day you get to it. So hopefully this is helpful, you know, in terms of the way I invest, the way I, you know, manage my own money. And again, you know, you should think about it, what works well for you, and talk to a professional financial advisor, you know, and work out with them as well. But that's my 2 cents. Let me know what you guys think. Comment below.